Hello, everyone. Good afternoon. Today on the final bar, we'll talk about a market distributing on a Monday, following through from Friday's pullback, but some green shoots going into the close there, with technology actually leading the way back higher. So, just when you feel like we're validating the downside, validating the distribution, validating the weakening breadth by everything sort of going down, tech sort of rebounds today in a way that makes me have some second thoughts. We'll go through all of that and more. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon, and welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at the price action together, tease out some themes, takeaways, big picture movements, understand what's working. And again, the goal, I think, of a technical analyst, a technically oriented investor, a trend follower, is to identify the trends, to follow those trends, and to anticipate when the trends are potentially reversing. And we've certainly seen this condition over the last couple of weeks, right, where you've had this rotation, right, away from a mega cap tech consumer-led bull market phase to a little more of a questionable period, with a lot of stocks breaking down through some key levels. The S&P itself breaking down through its 50-day moving average. But then on a day like today, again, it's all about mixed signals. And while I think the weight of the evidence overall suggests further potential downside, a day like today with tech up, with semiconductors breaking out on a relative basis, it feels like it's not all bad. So let's look at some of those things together. We'll see what takeaways we can bring out. Again, the goal on a Monday is to hit the market big picture, top down, also bottom up stock picking and sector rotation. We'll get to all of that and more. Now, we have some great guests coming up this week. Tomorrow on the 22nd, Timothy Brackett joining us from the Markets Compass for the first time. On Wednesday, Leslie Juflas returning to the shows from Trading Live Online, based here in the Seattle area. And then on Thursday, coming to us live from New York, Todd Sohn from Strategas Research Partners. Again, I think one of my favorite parts of the show is just to be able to talk with people like Tim, Leslie, Todd, and just pick their brain on what charts are top of mind as they go through the similar process to what all of you are doing. And so should be some really good conversation this week, given the volatility. Most important to let you know, though, tomorrow on September 22nd, our special event introducing StockCharts ACP. We're getting the final touches all lined up. We've had some amazing conversations with some of the top technical analysts in history, guys like Larry Williams, Ralph Acampora, John Murphy, Martin Pring, many, many more. We're going to present all of that with you. Chip Grayson and I from the management team here at StockCharts going to share with you the ACP platform, advanced charting platform, some of the capabilities, what you can expect using this charting system as it is fully released and out there for all of you to use and enjoy. So join us tomorrow, September 22nd, for introducing StockCharts ACP. Let's get to our market recap. As I mentioned, again, I overall, as I'm sure you can tell from the way I've made measured comments about potential for downside in recent weeks, I've certainly recognized the weakness in breadth, the warning signs from the FANG trade, the big mega cap stocks that got us to this point, and some of the warning signs across the board in a lot of individual names. And most importantly, it's looking at the S&P 500, seeing the 50-day moving average not holding on Friday. We get follow through to the downside today. And so the question always is, where do we go from here? What sort of short-term read can we get? So overall, as I'm looking at charts earlier in the day, feels pretty negative as you get a lot of stocks breaking down through the 50-day. And it's not just it's not just a broad index. You have things like, Disney breaking down through support. A lot of stocks sort of rolling over. Do you think, all right, this is really the piling in that we were expecting? But by the close, what happened is technology actually rallied, finished up 0.8% or so, I want to say, on the XOK. If you look at the S&P 500, It's this candle right here, which is actually a hammer candle, which is a big down day, but the again, down during the day, but you close back up to the open. So the open and close are right about at the same level. You have a long lower shadow, little to no upper shadow, and that actually is a short-term bullish candle. So it's actually suggesting potentially we get a bit of a bounce here. Again, I think a lot of that is driven by technology sort of recovering a little bit. So you had the MEI stocks, materials, energy, industrials, 1, 2, 3 at the bottom. They were down over 4% earlier. They came back up, still down over 3%. So certainly giving back a lot of the recent gains. And so again, instead of a full rotation continuing away from tech back into these other sectors, you sort of reverse, and you see when technology is up and everything else is down, it actually pulls the S&P up pretty good because there's a lot of cap in that sector. Utilities, number 2. Mid caps and small caps both going down pretty significantly, recovering a bit into the close, but the damage had been done, and so the small cap index down over 3%. The VIX back up around 2750. Looking at other markets, and again, a lot of movement. Bonds opened up pretty good, still closed the day in the form of the TLT up 0.5%. Stronger dollar is a theme that we've talked about. I actually wrote about this a week or two ago, blog post talking about a stronger dollar environment, what that might be, and we've seen a bit of a follow through on there. There's a lot more to go before I think we can declare the dollar to be in the clear. The UUP up pretty good so far today. In commodities, you had gold and silver down pretty significantly. Silver down over 7.5%, so quite a give back there, and oil down over 2.5% as well. So rotation away from commodities for sure. Looking at a daily chart of the S&P, and again, we're thinking big picture here, looking at the top-down sort of macro environment. When I'm looking at a chart of the S&P, I updated all these support levels over the weekend as I was looking at just the charts as part of my weekly routine. And I updated some of these support levels. It's funny, I actually drew this. This has been consistent from what we've talked about, sort of that 3,200 to 3,250 level. This is the peak from June, also the low from July. After we broke out, we sort of pulled back and went out. So this area is pretty key. We traded right down into this area and traded back above it. So again, the base case we talked about was we get to this range, which we now have as of today. The question is, do we remain here, and are we able to find support here? Again, short-term hammer candle suggests the next couple bars are higher. You break below today's low in the next couple of days, that would invalidate that hammer candle and tell you to expect lower lows from here. So we'll have to see where that is. The RSI is notably right at 40, just below that at 39, but I think within the margin of error. So sort of the bull market pullback point, that's sort of where in bull market phases, that's a lot of times where you get a pullback and you still can assume that the bull market phase is okay. When we start breaking down through 40, that's when you may want to be concerned about potential for downside. Looking elsewhere, we talked a lot about some of the big picture trends over the Friday show, and we talked about the big picture. The weekly candle actually, or the weekly market trend model came in quite a bit today, and this is obviously with today's weekly bar. So this is still active. This isn't locked in just yet, which is why we don't sort of officially start the clock until Friday. This is a Friday to Friday look, but it's worth noting that again, if we go much lower than this, you could get a sell signal from the medium-term model this Friday. Again, assuming a bit of a further downside going into the end of this week. We've not seen that yet today. Again, we finished down, but we're able to move higher through the course of the trading day. Last thing I just wanted to hit on was looking at the dollar. We talked about the dollar has been so weak. That's been obviously a theme that I think we've all either been aware of or you've been dealing with it through other bets that have been impacted by this. But the dollar really from March to September has come down pretty good. The UUP just broke to a new swing high and broke above its 50-day moving average for the first time since May. And if we continue on in that path, again, that's sort of that next leg higher that we talked about with this bullish divergence. We had lower lows in the dollar, higher lows in the RSI, kind of moving higher. That has implications for U.S. versus non-U.S. stocks, has implication for small cap versus large cap, a lot of different things. So worth paying attention to that chart for sure. That's our big picture recap for today. Our next segment is sector setups, and I want to spend a little bit of time on sectors because obviously we've had some movements today with technology going from, I was just about to, earlier today talking about, even when I we did a quick teaser video for today's show and talked about how, mega cap stocks were coming off, but the big cap tech names were actually holding up a little bit. Charts like Apple were actually holding up. They actually finished more in the positive today, Apple and Microsoft. So you can see the XLK is right here. This is the daily RRG, so the daily relative rotation graph. So a little shorter term, but what this is showing you just in the last couple days, this is, Thursday, Friday into Monday, basically how this is rolling up. You can see the technology obviously still underperforming, but starting to roll up a little bit. Staples, financials actually rolling down a little bit. You can see everything else as well, sort of rotating down into this, heading a little bit lower. So while the market has pulled back, you've had this rotation away from mega cap tech and communication services into materials, industrials, energy, utilities, all these other things that are sort of up in this leading quadrant. But just in the last couple of days, we're starting to see a bit of a rotation. Now, that doesn't, just because the rotation start does not mean it's going to complete and go all the way to the next quadrant, but it's worth noting that that is a theme that that could potentially be playing out. And preparing for technology to recover is certainly something you want to be looking at on any of these charts or potential outcomes. Switch to the weekly view. So now we're looking at the same 11 sectors, but we're broadening out a little bit. Now we can see this longer term theme of industrials improving, of materials remaining relatively strong, consumer discretionary now the strongest of the 11 sectors furthest to the right. You can see technology, communication services rotating in the direction of deterioration southwest. And so this is the longer rotation that we've seen, is a rotation away from technology, away from communication services, into industrials, into materials, into consumer discretionary. Again, the shorter term read shows you how just in the last couple of days, we're seeing a bit of a bid in for technology. The question now obviously is, have these technology names that have pulled back 8-10%, whatever the particular number is that enough? Is that enough of a pullback? And have we just reset reset the whole thing and we continue to go on to new highs? Or is this the first of multiple legs downwards? And again, I think the key is looking at the charts, looking to the left, seeing what levels hold and what levels break. And with that in mind, let's look at the 11 S&P sectors. So now, we talked about the S&P remaining above its 50-day moving average. I think what you want to pay attention to here is what sectors are doing, what individual sectors are doing relative to their 50-day. How many of them are holding? How many of them are breaking down? When they do, how many get to their 200-day moving average? How many hold there? It's the sort of exercise you do. So you can see things like materials. And again, we'll pop these charts up in a second, but you can see very quickly materials pulling back right to its 50-day today. The same with industrials. Where else? I think that's it for the two leadership sectors. We talk about the emergence of these two. And again, overall, the trends are still positive. So it's worth noting that they haven't really broken down yet, especially on a closing basis. So here's the XLI trading right around 75, 87 or so was the close. You can see this is lining up from the previous closes on pullbacks in August and earlier this month, earlier in September. So we're actually holding that right now. And on an intraday basis, traded down to the 50-day, but didn't close below it. So overall, it's sort of still in that garden variety pullback sort of indication. You would want to see a break, or not you'd want, but you would need to see a break below the 50-day, break below support levels to confirm a little further potential downside. Same with the XLB. It's actually holding support, holding the 50-day at this point. So still, thumbs up in the green. Little more concerning are things like consumer discretionary. So what happened here is you've now had lower highs and lower lows, with the low on Friday really pushing it to a new swing low. We've now broken below the 50-day, but the XOY, you can see just like the S&P 500 has a hammer candle. Might be a little hard to see, but you can see it's actually a hammer candle, which suggests a bit of a short-term bounce. That tells you about the next couple price bars, most likely higher rather than lower. And the low of today is what you'd usually use as a sort of support level, as a stop of sorts, if you're thinking of that. Technology we're looking at here. So actually closed in the positive. This is the only of the 11 S&P sectors that closed positive. I'm going to zoom in just to the last year so we can focus on a little bit, because a key part of this, I think, overall bearish thesis here would be a deterioration in technology. And even though you could see it holding up on a relative basis, you'd certainly expect price levels to be breaking and violating more lower lows. It broke the 50-day on Friday, closed below it for the first time since back here. But then today, it's not I would say, the most ideal candle pattern suggesting a short-term bounce. You could argue it's called a bullish piercing line, where you have a long down bar, a long up bar, and we get at least 50% of the way through, which we don't have to go to the tape on that one. I'm not sure that's 100% there, but certainly seeing accumulation out of the weak point today. So earlier today certainly felt like follow through to the downside validation. I don't think we got the downside follow through or validation on the XLK that you might have wanted if you'd expect further downside. Here's a relative strength, which again, after breaking down from a recent trend line, has actually held up okay. In our shifting stock segments, we're going to get into some of the individual names that make up these sectors and tease out some of the themes that I think are worth paying attention to. Finally, I just want to point out with financials, with energy, I've been hopefully steering you away from leaning into those. I think with energy as a sector, when you're thinking of allocation, it's hard to justify, if not impossible to justify, going into energy, given the weakness in the charts. They just continue to go down, and again, down and to the right is not the type of chart I tend to get that excited about. Financials were sort of threatening, right? Sort of teasing this 200-day moving average, as it's done a couple times. I think you can say safely now it's failed there, having now made another lower low, have now made back below the 50-day moving average, a new swing low, breaking below the low from the last month. So overall, you're certainly seeing some weakness in financial. So again, I don't see this as being a great opportunity from a purely technical perspective. I think you want to look elsewhere where there are opportunities. And if the financial sector continues to go down, I think it's a reasonable bet to look around 2250 on the XLF. That would take it back down to the lows from June and July. It's also the part of this gap that occurred out of the big move out of that May swing low as well. So sort of a number of different levels all around 2250. That's a reasonable pullback objective if you see further downside with financials. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, please get your questions to us. We'd love to hear from you, answer one of your questions on the air tomorrow, which will be our next mailbag segment. You can email us at thefinalbar@stockcharts.com or just tag us in a Twitter comment at FinalBarSCTV. Finally, you can put a comment below any of our videos on YouTube, wherever you see our content. We'd love to capture all of those. It'd be great to hear from you. Feedback on the show, feedback on our guests, on our hosts. Most importantly, questions you're running into as you go through this journey of analyzing the markets from a technical perspective. We're here to help you, and we'd love to answer one of your questions on the air tomorrow. Our next segment is called Shifting Stocks, and the goal here is really focus, now that we've talked about the top-down macro, talked about this weakness in the S&P, the internal weakness, but a bit of a bid going into the close. We've talked about sector rotation, how technology had been certainly selling off, but actually was the one sector to go back higher today. And we had the materials, energy, industrials really rolling over today, which certainly speaks to some challenge to the long and strong thesis. We now get to the individual names, the bottom-up stock picking, and part of my process every Sunday, every weekend, is to go through the S&P 500 one by one and just focus on patterns, trends, themes, what jumps out at me. And I have a page worth of tickers and random comments that I scratched from yesterday to this morning. So I will pick on as many of these themes as we can. And if you have other questions, shoot them to me via email. We'll start with Disney. As I mentioned, when I'm looking at the broad market and seeing the S&P threatening its 50-day moving average, going below it, closing below it, following through a bit to the downside today, the question always is, what are the individual stocks doing? And one of the breadth indicators we talk about is the percent of stocks above their 50-day moving average. And a lot of times, again, the whole benefit of that bottom-up process, that breadth analysis, is to see what the stocks that make up the indexes are actually doing. So let's look at a couple of these. Disney's actually closing below its 50-day moving average today. So, I think a general pattern that I would be looking for is, have a bearish divergence on Disney, higher highs in price, lower peaks in momentum. We've seen that on a number of stocks. we pulled back a little bit, but going into Fridays, I was looking at this over the weekend. I'm thinking, well, it's still holding its 50-day. It's still holding price support. So how bad are things if a stock like Disney is still holding up? Unfortunately, that all changed today, right? We actually broke to a new swing low. We broke down through the 50-day moving average, which means, from a purely technical perspective, I'm looking down into this range around 110, 112, which is the lows from June, really coming back off of that June market peak when it tested its 200-day moving average. So, you sort of cleared the support level. The 200-day is not far below, around 122.75. But assuming that breaks, I think there's a bit of a downside. So movements like that suggest to me that there might be further downside. Other things to think about: we talked about the strength of things like Fox. We talked about FedEx, FDX, Freeport McMoran, FCX, and Fox. We talked about the FX trade last week, and Fox, unfortunately, Friday week, today week as well, sort of following through. So all of a sudden, it looks, instead of like a stock that's sort of breaking above its 200-day with staying power, it actually closed above its 200-day, and just like in June, has rotated back lower. This is coming off an overbought condition similar to what it had in June. So when I see stocks overbought testing their 200-day moving average, this is why I tend to pay attention to that, because I've seen that pattern before, where it's sort of a recognition that it doesn't belong above there. There are plenty of things to get interested with in communication services. And again, I'm going to tear through as many of these as I can. Alphabet has actually pulled back to its 200-day moving average. So the question with a lot of the FANG stocks is, now that they have pulled back, they've certainly shown some weakness, showed some potential to pull back in some ways, pretty meaningful ways. It's down 300 points from its peak just a couple of weeks ago. It's now testing its 200-day moving average, also very close to the low from late June, which is around 1350. So we're right in that sweet spot of support, where if this is sort of the end of the pullback and stocks like Alphabet recover, right about now is where you'd expect that to happen. So I think it's an interesting chart to pay attention to. Worth noting, a number of the video game stocks are actually up today. So when the market overall is down, stocks that manage to move higher are interesting. So Electronic Arts, Activision, Take-Two, all more positive than negative. Netflix as well, sort of bouncing out. So overall, again, testing the lower end of support around here, 460, 470. That's sort of the lows from July and August. We're sort of right at that sweet spot. So far, bouncing off of an RSI around 40. So chart of Netflix actually doesn't seem that bad. Again, assuming these levels are able to hold, 460 is a good support level, I think, to look at there. Looking into consumer discretionary, just a couple ideas. Target is a stock that's threatening a new 52-week relative high, and looking in a down market, when there's a pullback, when there's some weakness, stocks that are actually able to move higher, especially on a relative basis, can be interesting. So Target fits the bill. Whirlpool, WHR is a chart we've talked about. Again, that hasn't even touched its 50-day moving average. The relative strength still moving in the right direction. So you look at today's bar, what it was able to do is actually a pretty resilient buy signal. There are a couple charts that are sort of in that potential buy on weakness move. I don't have the Fibonacci retracements on here, but if you drew them and you started the low here in March, you did the high there. We've got time. Why don't I do it? Here we go. So we take the low here, we connect the high in July. We then line that up, and you can see we're right at that Fibonacci retrace. Sorry, I'm shouting here with Fibonacci lines, but you get the low from March, the peak from July. You look down, we've retraced 38.2%. That lines up with the June low. We're oversold. I don't know. I don't think it would be that bad to take a shot at something like this. It's up 3%. That's eBay. And again, I'm not going to draw all of these, but Apple is actually right to its Fibonacci support level as well. Let's bring that up. And sorry, I'm now full on jumping around sectors, but the same thing. Take the March low, take the peak there. We had that great bearish engulfing pattern. We're right at 38.2%, which lines up with the upper end of this gap, sort of continuation gap you had there from late July. So just above 100, a big round number. So I don't know, that actually could be an interesting one. PayPal might be another one, sort of pulling back to key support levels. So there are stocks that have actually pulled back to decent support levels, decent long-term charts that overall have pulled back, and especially eBay and Apple come to mind as interesting potential Fibonacci support levels. Let's see, something like Coors, Molson Coors Brewing Company. This is TAP. A wise man once said, never confuse the bottom of the page with support. So I'm always hesitant to assume, just because it's gone down a lot, it's never a great idea. However, I can't help but notice it's oversold right at its long-term low level there from July. So in terms of risk reward, you're getting in pretty much at the lows of the previous range. And again, the danger or the risk to that would be you'd obviously continue lower. So, trailing some sort of stop, some sort of percent stop, what you'd have to think about for a name like that. But it's interesting, worth noting that it's back at previous lows. In terms of what concerns me, things like Regeneron are sort of this just beautiful rounding top. A lot of times stocks go up and they accumulate over time, but then the pullbacks are a little more sudden. That's what we've seen a lot in the mega cap tech names. Look at this big rounded top, though. It's sort of unusual, but undeniably in a pattern of lower lows and lower highs. And I'd rather buy things that are more in an uptrend of sorts. Things that are within healthcare sort of popping off of support. DGX comes to mind. That's Quest Diagnostics, bouncing off of its 200-day, similar to what it did in June. The relative strength obviously improving because it's higher highs and higher lows at a time when the market is not. So this is an interesting one because it's a very different pattern than what you've seen in a lot of other sectors, a lot of other stocks. LH is maybe a similar one. This is LabCorp of America. As you can see it again, sort of rotating from distribution to accumulation. It's a bit unusual because most things have sort of come off. And then you also have all the medical supply stocks, TMO, ALGN, HOLX, WST. Those are all within medical supplies charts that are they're actually improving a little bit. With industrials, there's been a lot of discussion about the return of the industrials trade, and I can't deny the fact that there's been strength in industrials overall. I think a chart like DEER, DE, is holding up very, very well. And if you look at the long-term trend, it's positive. If you look at the relative strength, it's fantastic. But again, I can't help but notice the thing that jumps off the page for me is the bearish divergence on here. So what could happen if you get further weakness or charts like this start to break down through support? So something like DEER, the way you'd validate the bearish divergence is you break down through that low around 208, 207, call it. So I think that's the key level you'd be looking for. Interesting to see through the course of the week if we start to break through some swing lows, because those are names that have held up very well. Finally, I just want to finish off by talking about semiconductors. So what's interesting, and again, we don't have time to go through all the names, but if you go across the board, AMD, LRCX, KLAC, NVIDIA arguably maybe one of the better charts in there. The semiconductor ETF has made now a lower high. It's made a lower low. That's concerning. The relative strength, however, is rotating back higher. So it's actually holding up. It's not going straight down like some other names are that I could show you. So on a relative basis, semiconductors have held up. As you remember, if you remember on Friday, we looked at the relative strength. When we looked at the relative performance of semiconductors versus the S&P, you can see it's actually held up very well. And so I think the ability of semiconductors to remain positive, especially on a relative basis, is actually potentially constructive. It's something to pay attention to, and if it's able to hold, especially able to hold support levels, I think that's concerning. If you go under the hood, though, I would caution you that there's quite a divergence. There are some semiconductors that look a lot stronger than others, so it's worth paying attention to. That's it. We need to get right to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is looking at the percent of stocks above their 50-day moving average. That's this line down here in green. This is one of the breadth charts that we looked at on Friday. And again, my base case for breadth overall using this particular indicator is as long as over half of the S&P is above its 200-day moving average, long-term, the trend is still positive based on the breadth characteristics. It's more characteristics of bull markets than bear markets. And I think 2019 illustrates that pretty well, where some of the pullbacks that you saw in the middle of the year saw that hold around 50%. Same thing back here in 2018. So on a pullback, that's sort of what I'm looking at. We're still above 60%. This is not updated through today yet, so this might come off a little bit going forward. 50% on the 50-day moving average is also key, and we're just above that on Friday at 52%. I think we're going to go below 50% on here. That sort of suggests again that a lot of stocks are not able to hold the 50-day, just like the S&P was not. So I think watching that and seeing if that continues could be very, very key. Chart number 2 is looking at the relative strength of semiconductors. We looked at the regular chart of the SMH. This is the chart that's part of our Mindful Investor Live chart list. And again, what we looked at on Friday was this coming off, and today it's just breaking above that. I was asking if this is a bull flag pattern, which I said it wasn't, but boy, all of a sudden it's starting to move to the upside, and it certainly feels like you could see the potential of this group sort of working. Finally is Apple, and I don't have the Fibonacci retracement, but that's the key here, the low from March, the peak from earlier in the month, and coming off on the pullback. Folks, that is our show. Thank you so much for joining us. We'll see you the rest of the week here on the Final Bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.